Dear students, welcome all to the second part of Unit 1 Risk and Insurance. Hope all of you understood on what is risk, what are all the characteristics of risk, causes of risk, classification of risk and method of treating risk from the previous session. In this session, we will see the concept of insurance, features of insurance and functions of insurance in detail. Let me introduce the insurance concept to you. These risks cannot be eliminated altogether, but can be reduced by taking certain precautionary measure. Although many of these risks can be reduced or lessened, the unfortunate victims of these risks cannot bear the consequent suffering of themselves. Someone has to bear the responsibility, and these unfortunate persons on whom the loss has befallen should be relieved from the burden. So, there is a need for a device or machinery or institution to provide necessary help to them. Such a device is known as insurance. The institution providing such a help is called insurer or the insurance company, and the person for whom the protection is offered against the happening of the stated contingency is known as insured or policy holder. So, what do you mean by insurance? Insurance is an arrangement under which people facing common risks come together and make their small contributions to the common fund. When risk occurs, the loss is made good out of the common fund. In fact, they share the loss by payment of premium, which is calculated on the livelihood of loss. For example, in a town there are 1000 motorbikes, each valuing rupees 40,000, and they are owned by 1000 individuals. It is expected that every year one bike is totally damaged in the town due to an accident. Hence, with this element of uncertainty, each one of the 1000 bike owners is exposed to the risk of losing his bike, the cost which is rupees 40,000. To avoid this loss, all the 1000 bike owners decide to take policy in the insurance company and pay rupees 40 as premium towards a common loss which may fall on any one of them. When a bike is destroyed, the insurance company will pay the loss of rupees 40,000 is equally divided among 1000 owners, and their cooperation makes it possible against financial ruin. Against a definite loss of rupees 40 per year, he protects himself against a possible loss of rupees 40,000. In a way, he pays a price of rupees 40 to purchase protection to the extent of rupees 40,000 against the loss by accident. So, how can we define insurance? According to McGill, insurance is a process in which uncertainties are made certain. According to Rockwell, insurance is a source of distribution of loss of a few persons into many persons. Let me repeat this: few persons loss into many persons. Thomson has defined it as insurance is a provision which a prudent man makes against fortuitous or inevitable contagious loss or misfortunes. It is a form of spreading risks. According to Chief Justice Tyndall, insurance is a contract in which sum of money is paid by the assured in consideration of the insurers incurring the risk of paying a large sum upon a given contingency. Shall we look into the features of insurance? On the basis of the definitions of insurance we discussed, one can observe the features. First of all, we take the feature contract. Insurance is a written agreement between the insurer and the insured, wherein the insured makes an offer and the insurer accepts his offer. Then consideration. It is a contract under which the insurer, in a consideration called a premium, agrees to take over a particular risk of the other party and promises to pay the insured or his nominee a certain sum of money on the happening of an uncertain event. Then cooperative device. Insurance is a cooperative device under which a group of persons who agrees to share the financial loss may be brought together voluntarily or through publicity or through solicitation of the agents. An insurer would be unable to compensate all the losses from his own capital. So, by insuring a large number of persons, he is able to pay the amount of loss. Protection from financial risk. In this property, it offers protection to those risks which can be measured in terms of money, that is financial risk. The next feature is certainty and contingency. The life insurance is a contract of certainty, as the insurer has to pay the amount as compensation to the assured if he survives till the date of maturity of policy or to the nominee if he dies earlier. In other insurances, the contingency, namely fire, theft, earthquake, accident or the marine perils, may or may not occur. So, only the happening of certain contingency payment is made, otherwise no amount is payable to the insured. Then insurance is not a gambling. The insurance cannot be considered as gambling, as the insurer has to indemnify the loss incurred by the insured on the happening of an uncertain event as stipulated in the contract of insurance, whereas the game of gambling may either result into profit or loss. The next feature is insurance is not a charity. The concept of insurance is entirely different from the concept of charity. The charity is offered to the poor or needy without expecting any consideration from them, but the insurance offers protection to the insured life and property only after getting consideration in the form of premium. Insurance is based on certain principles. The contract of insurance is based upon certain principles such as insurable interest, utmost good faith, indemnity, subrogation, causa proxima, contribution, etc. Large number of insured persons. Large number of persons have to be insured to spread the loss cheaply and smoothly. If only small number of persons are insured, the cost of insurance to each member will go up. Ultimately, it will become unmarketable. Therefore, to make the insurance cheaper, a large number of persons or property have to be brought under the umbrella of insurance. If an insurer admits more number of persons, the cost of insurance will come down automatically, thereby lower number amount of premium can be charged on the insured. The next principle is investments. The amount of premium collected from the insured by the insurer is being invested in different securities. Such securities fetch income to the insurer in the form of dividend and interest. The insurer thus could get two sources of income, the insurance premium and the investment income, which occur over time. So, we can list out the features of insurance as: it is a contract only for consideration, it is a cooperative device, protects the financial risk, it is not a gambling, it is not a charity, and sharing of loss by many. Our next topic is the functions of insurance. What are all the functions of insurance? Insurance performs a variety of functions which are advantageous to the common people directly or indirectly. As such, functions of insurance can be divided into three categories. Number one is primary functions, then secondary functions and other functions. We are going to see one by one. Primary functions. The main functions which are performed by the insurance are detailed as here. It provides certainty. The main function of insurance are to reduce the risk or uncertainties of events. Risks involve usually when, how much and to whom one will lose on the occurrence of an uncertain event. Insurance is a means to indemnify or compensate the losses caused by the uncertain events. The insured converts his uncertainties into certainties by paying premium to the insurer. J.H. Magee has rightly pointed out that the function of insurance is to provide certainties. Then insurance distributes risk. The concept of insurance is based on the law of cooperation. D.S. Hansel mentioned that the primary function of insurance is the spread of financial losses of insured members over the whole of the insuring community, and D.H. Magee has described insurance as a plan by which large number of people associated themselves and transfer to the shoulders of all risks that attach to individuals. As such, insurance is a means of distributing the losses of any uncertain events among a large number of persons covered under the insurance. Then it provides security. Another function of the insurance is to provide to the persons against the risks to uncertain events. Under the contract of insurance, the insurance company guarantees the insured person to compensate or indemnify the losses on the occurrence of an uncertain event in consideration of premium paid by the insured. Hence, the insurance provides the feeling of security against the evil effects of the uncertain events, that is risk. So, what are all the secondary functions of insurance? Insurance performs numerous other important functions classified under the category of secondary functions. Insurance provides capital. It provides capital, a scarce source of production, to the industry in various forms. First of all, it reduces financial risk and losses by providing facilities of core capital investments in various giant organizations. Next, the amount received on account of premium by various insurance companies is made available for the industrial development of the country in various financing forms, such as by providing of share capital, providing long term loans to companies, and term loans and loans to the state to invest in the country's public sector industries. Next, insurance makes the company or organization to avail loans on easy terms by hypothecating the insurance policies. In these days, financial institutions and banks have imposed conditions that asset must be insured if one wants to get loan against that asset. It increases the efficiency of the organization. Insurance, by reducing the risks or security in the business community, which in turn becomes a source for the growth and diversification of the industry. Management is relieved of the various risks involved in uncertainties, becomes able to give due attention on other factors which affect the total efficiency of the organization, such as labor force, material management, marketing, etc. As such, insured persons can work better for profit maximization. It helps in judging the viability of major projects. Before insuring the assets or property of any organization, the insurer generally conducts as investigation of the assets or project as a whole with a view to judge the profitability of the project. Unprofitable projects or organizations are denied the benefit of insurance. Hence, the management may drop such projects or units in advance in order to prevent losses. Then, insurance helps in loss reduction. Insurance company not only secures the losses, but also advises the adoption of various methods and techniques which help in reducing the risks or losses. Say for example, under fire insurance, stress is laid on prevention of fire and use of firefighting means. In India, Loss Prevention Association has been established with the objective to suggest the public various techniques which help in reducing the losses and accidents caused by uncertain events. The other functions of insurance are, in addition to the primary and secondary functions, insurance companies performs various other functions which prove beneficial to the common man, business community and the nation as a whole. We will see few of them. Expansion of foreign trade is one of the important function of insurance. Insurance provides security to the international traders, shippers and banking or financing institutions which are the main functionaries to the foreign trade. Thus, insurance promotes foreign trade and helps in earning or securing valuable foreign exchange. Marine and fire insurance play a vital role in this regard by providing much needed protection against the perils of sea. Then, insurance providers funds to invest. Insurance companies collect funds by way of premium and employ or invest it profitably in the industrial development of the country. In India, Life Insurance Corporation along with other insurance companies provides larger sums to various industrial and business concerns. Then, insurance encouraging savings. In these days, insurance is considered to be a better alternative technique of making savings. Under the contract of insurance, the insured has to pay a definite premium compulsorily. At the initial stage, it seems to be forced saving, but later on it becomes the habit of the insured to save a certain sum periodically so as to pay premium regularly. As such, forced saving curbs the unnecessary expenses of the individuals. Then insurance checks inflation. Shall we see how it is? Insurance is an important yardstick to check inflation. It curbs the circulation of money and saves if from its ill effects. Compulsory savings in the form of premium reduces the spending volume of the individuals, and this scarce source of production is utilized in a better way by investing for the national development. Then insurance gives self-confidence and goodwill. Insurance, by providing a feeling of security among the insured, also creates self-confidence in them. Thus, insurance not only provides protection against risks, but also provides capital to the insured, which becomes a source of financial stability and strength. Credit is also advanced on insured property or assets because insurance works as a security of the loan. As such, insurance increases self-confidence, reputation and goodwill of the insured. Then insurance provides social security. Insurance provides an instrumental force to fight against evils of poverty, unemployment, disease, old age, fateful accidents of person and property and similar other calamities of nature. Insurance has helped in a greater way by establishing or devising various types of insurance in our country, like Employees State Insurance Act, Provident Fund Act 1932, Workmen's Compensation Act, etc. On the other hand, insurance helps in spreading education to the masses regarding adoption of techniques for minimizing the happening of controllable uncertain events. Then insurance provides credit facilities. Above all, businessmen are in a position to raise loans and get credit facilities from various financial institutions and banks by pledging their insurance policies, and in case the insured trader becomes unable to return the loan or credit, then the financial institutions can recover their amount out of the policy surrender value. So, the functions of insurance are consolidated now. Insurance gives protection, certainty and capital. Then insurance distributes risk and loss. Then insurance increases efficiency, economic progress, financial coverage and foreign trade. Then it promotes savings, credit facility and social security. In this session, we discussed on meaning of insurance, definition of insurance, features of insurance and functions of insurance in a detailed manner. In the next session, we will take the next topic, which are the origin and evolution of insurance, then kinds of insurance and importance of insurance. That's it for today.